All right, on this week, we're going to talk about something that a lot of people have been pinging us about, and I've seen an uptick in the last year with people coming back, get policies on their children. So we call them juvenile policies, but it's really any of your kids who are not adults yet. And we talk about why you might want to do this. So what else did we cover in this episode, Paul?
Well, yeah, that just about covers it. We talked about Nelson's book, Becoming Your Own Banker, page 71 and 72, and we hit those kind of highlights on page 72. I'm actually looking at them right now. And then we covered some other additional points that are not covered in Nelson's on page 72. So I think this was a good episode. I think people will find it helpful. I think we started, the why one would do this, I think is the most important thing to understand. Kind of just like IBC, why would one pay high premium into dividend paying whole life insurance?
Yeah, start with why.
So start with why, same sort of mindset. But no, this is good. And again, if you have children that were just born, we have a client that's opening up policies on his grandchild right now. That's Wes. Give a shout out to him.
All right.
But if you've recently had children, you need policies on your children. Even if they're small, that's fine. They got to start somewhere. But lock in their insurability now. Anyway.
Even if the child is small or the policy premium is small? You said even if they're small.
The policy, yes. Talking about the policy premium.
Okay.
Chances are your child, it's all relative, but
it's all relative.
The premium, the premium might be small, $85 a month or something.
Yeah.
Right. It's totally fine.
Yeah. So, okay. Also, check out the show notes. Click on that first link there to register for the upcoming webinar and bring your questions. We'll see you there. Hey, I'm Dave.
And I'm Paul.
And this is the Wealth Warehouse Podcast. All right, we're back. What is going on?
Not much.
Nothing? Yeah, not much at all, huh?
Not much at all.
Good for you, man. Good
There's
for
a bunch
you.
of things on my punch list that I need to execute. And I find that if I make a list, I do them. If I do not make a list, they do not get done. So I'm a big fan, again, of reinforcing, make a list.
Things that get tracked get done.
That's right. Exactly right.
I've got to always have a list right there on my whiteboard in the office, to-do list. So
Yeah, that's why I'm looking forward, I only use this room that I'm in to record this podcast. I'm never in here because I don't want to be in here. And I know where your office is. It's nice because you're on the main floor of the house. The kitchen's right there. I'm looking forward to having an office right off my, the main great room of my home. I hate being up here. It's just
feel secluded.
Yeah, just secluded. I mean, there's nobody here. It's just me and the dogs.
Yeah.
But it's still just no.
Well, they say enclosed spaces are good for focused work, but creative work, you want to be in an open space. So, however that helps you.
Yeah, well, I'm not very creative, but...
Well, maybe because you're always in enclosed spaces with no windows, like at the Pentagon or something. Right?
Oh, gosh, yeah.
So you need... Now that you're out of that, you can... your office will have plenty of windows.
Yep.
So that makes a huge difference. Just seeing the outdoor, seeing the nature. It's great.
Mm-hmm.
Well, so we've had some requests recently from some clients that they want to know more about juvenile policies. So policies on the kids. It's kind of a strange concept. Not to us anymore. It's kind of just, it's second nature. Of course I want policies on my kids. But it's a kind of a strange and odd concept to talk to the random person in America, and they've never even considered having a life insurance policy on a child. Like, why in the world would you do that?
Right.
So let's start with why. Why do you have policies on your kids?
Well, we are trying to create a family financing or family banking system using dividend paying whole life insurance so that we can practice IBC generationally. I'll direct everyone to page 71 and 72 of Nelson Nash's book, Becoming Your Own Banker, the 5th edition. If you're on the 6th edition, on a Kindle or on the audiobook, I can't really help you, but the 5th edition, which is the edition you should own a hard copy of, That's where you'll find. But I mean, Nelson lists a bunch of reasons, and I can't tell you when I underlined some of this, but I think maybe, Dave, it might be beneficial just to read these off real quick.
Yeah, you talking on page 72?
I am on page 72.
Yeah, I mean, we could go
the right corner.
Shoot, this could be like a 2-hour episode just on these points. But yeah, go ahead. Let's just elaborate a little bit on those.
So right above that list, Nelson is talking about, as each generation becomes grandparents, they buy life insurance on their grandchildren. If this message is passed on to each childbearing generation as they become grandparents, then you can create the same effect as the even distribution of age classes, where he was talking about forestry and trees and harvesting them for cash flow. Anyway, even distributive age classes in the growing trees, but it is far more profitable and certain as to the results when you use whole life insurance. No forest fires, no plant diseases, no storms, no property taxes. And this is the important part. You have created perpetual motion in your family's financial world. And then he goes into the list. First thing, it covers multiple generations and promotes long-range planning.
Yep.
Thinking long range, one of Nelson's bedrock principles.
Yeah, absolutely. And multiple generations. It's not all about me. It's not all about my life, my generation. It's about, just perpetual motion.
Yes, just like we see in Proverbs, Paul, a good man leaves an inheritance for his children's children.
There you go.
Proverbs 13:22a.
Yep.
So.
Yeah. So, I mean, there's plenty of other reasons. So let's go down the rest of these. So underwriting problems are minimized.
Yes.
Because what's the underwriting process for a child, for a juvenile?
It's fairly minimal. Generally, it's the same application. You fill it out. We submit it. There's medical questions about the child on there. Did you see the child? Whatever. It's the same application. The underwriters will generally make a phone call, or not the underwriters, but it's somebody on behalf of the underwriting team, with a series of questions for the parents. It takes 5 minutes or less, and within a few days they get approved. The catch is, death benefit wise, the child can only really have 50% of the least insured parent's death benefit. So if mom is insured, if mom is the non-working spouse and she has $1 million of death benefit, the most death benefit underwriting that can be accepted is about $500,000, about $500,000.
And that's general guidance. Because each company may have different stipulations on that, but in general, you can't be an uninsurable set of parents. Mom and dad, no insurance, but we want to get insurance on the kids. That's going to be it. There may be some ways to do that, but you're not going to get much because they're, in typical. I mean, why would the parents not have insurance? Like, why would you get insurance on the kids? If in the case that you're uninsurable, that's a different situation.
Correct. Right.
Yeah. But you want to continue, you want to practice infinite banking, or you want to set your children up for success in the future. Absolutely, you can still, get some policies on them. However small, there's still going to be something, especially as they get older. They're gonna grow and grow, which is what leads into the next bullet. But I guess more on the underwriting before we pass on from that. It is a very simple process. There's no fluids, so there's no blood drawn from a little kid. They're not going to make your kid scream and cry about that.
No.
So it's very simple to get through. And the amount of premium, because I don't know if that's going to be on this list, but the amount of premium you pay is generally going to be far less than what you would create for a policy on yourself, because a little bit of premium buys a whole lot of death benefit for juveniles.
Yes,
because they have a lot of years.
And you're not looking to use all your child's future human life value up on a juvenile policy. Although I suppose in theory you certainly could. It would still take a tremendous amount of premium to do that, though, and you yourself would have to have a tremendous amount of death benefit that you carry, in order to do that. And most people just don't, including us.
Yeah. So what's
appropriate juvenile premiums?
And what's the typical premium you see for juvenile?
I think I think between 3 to 10,000.
I'd say the same. Yeah. I mean,
Somewhere
easily, $2,500, $2,400, $200 a month, something like that, up to 10,000. I don't really see it for more than 10,000 because it's kind of hard to get that much through underwriting with the amount of death benefit that gets the kids. So there's also limits. You're not going to be able to insure a child. Even if mom and dad both have 10 million, you're probably not going to be able to get the child insured for 5 million. That may be tough to get through underwriting.
Maybe.
You can try. But they're going to want to know, why is this child worth $5 million?
Right.
Maybe they're a child actor.
I'm just using your guidelines.
Yeah.
This child has unlimited potential.
Unlimited. Yeah.
Promote ahead of peers. All right.
So the third bullet's one of the best ones there.
Right. Yeah. So Nelson says the tax-free buildup of cash values over a long period of time.
Man.
So when you look at a juvenile policy, and I've got we've got them on our kids. Our kids have had whole life since they were 30 days old, and they've had dividend paying whole life the last 6 years. It takes very, very little premium to create a tremendous amount of wealth later on, actually. Mm-hmm. And the reason that is, and I'm reading a book right now called The Psychology of Money, and talks about Buffett, of course, Warren Buffett. And he said Warren Buffett is not the most successful investor of all time. There's other people younger that have a better average compounding, rate of return on their money, right? I think Buffett, he said, was around 22%, which is phenomenal. And there's some other guy that's like 30 or 40% or something. Anyway, what Warren Buffett has is he's been an investor since he was 10 years old, and he's 90 whatever now. He's had time.
Time. Yep.
He's had time. And that 40 extra years of time that he has over this next best investor, or better investor technically on paper, is time, which that other guy will never catch up because he's
right. Which is why there's something like 90% of Buffett's net worth has come in the last 10 years. Some stat like that,
Sure.
I might be.
He didn't become a billionaire until he was like 55 or something, I think.
Yeah. Right. So it's that compound interest. It's the time, and you can't buy it when it comes to this kind of stuff.
Nope.
But if you buy this early on these kids, you can actually see when are they going to hit $1 million in cash value? When are they going to become bona fide millionaires in cash reserve millionaires, not paper millionaires.
Not right.
Yeah.
Not
this is
home equity millionaires or 401k millionaires.
401k millionaires, but
go on YouTube. Yeah, go on YouTube, and there's a million videos about 401k millionaires or the average 401k balance by age. Like, all these videos are stupid. I guess they're just designed to see where you stack up.
Yeah.
But the internet is just riddled with that stuff. Anyway, so yeah, long duration, generational thinking, time horizon extremely long, just creates a tremendous amount of wealth for very little money.
Yep. Next bullet, outlay is very small compared with the ultimate yield. We've been talking about that. I mean, you do, say, $5,000 a year policy, 40 to 50 years in there, they got $1 million in cash value, illustrated.
Right.
Like you put in maybe a quarter of that amount over premium.
Yeah, it becomes really, really, really amazing. And I'm looking forward to opening up my children's next set of policies. So this is kind of a good exercise. I remember my financial advisor way back in the day had us do this and showed us on paper, like every year you delayed opening your Roth IRA or something, like $250 a month. If you're 22 and you wait till you're 25, and the difference 40 years down the road, assuming the same rates of return, they probably used 8% or 12% or whatever they were using, doesn't matter. The amount of money that was the delta is hundreds of thousands of dollars 40 years later.
Yeah.
So every year you delay it costs you a lot.
Which is funny. The financial institution that was more than happy to take my money when I was a young lieutenant, front loaded their investments and never showed me that graph on how big of a difference that makes down the road. But hey, it's only going to cost you. Your expense cost is way lower because we're front loading it.
But we did get some of that money back in that.
We did. We got $300.
Yeah, we got
Whoop-de-doo.
like 600 and change between the two of us. Yep.
Yeah,
So,
and they were like, or you could not cash this check and receive one-on-one, advice
right.
time for this $300. Like, how about I just cancel everything with you and leave?
See you
I did.
later.
Yep. Anyway,
Oh gosh, that was so stupid.
how about this one? The generation paying the premiums can most easily afford them.
Right.
So initially, I'm paying the premiums on my kids' policies. At some point, I may decide, I don't have to, but I may, when each child is ready, not a particular age, but when they're responsible enough for me to hand that policy over to them, make them the owner, and they can start paying it. I mean, $5,000 a year when they're 30 is going to be nothing.
Right. Hopefully.
Hopefully. One, because of inflation, but two,
Sure.
I mean, it's $5,000 a year, and by that point, that $5,000 is creating well more than $5,000 in cash value every year for them.
Yep.
So they're absolutely going to want to do this. But then I can pass that on to them and say, "Hey, you pay it. I'm done paying it, but guess what you get? You get all this cash value
Yep.
that you have access to, and there's no tax implications for you, son. You have access to like $50,000, $100,000 in cash value now. Use it smartly. Become your own bank, and you're not going to be taxed on that."
Yeah, and of course your boys and and my kids will have been mentored and trained. They'll have read Nelson's book, hopefully multiple times, and they hear us talking about it and just keep reinforcing it so that when they are ready, and that's a maturity thing and a responsibility gauge, not a it could be when they're 18.
Right.
Right.
Exactly.
It could be never. Yeah, who knows?
Yep.
Hopefully that's not the case. All right. So when death benefit occurs, so when we graduate, right, the system becomes self-sustaining. What is he talking about?
So when I graduate, I could set up my estate so that even after I'm gone, I can really dictate what that death benefit does. And maybe my rules that I set up for my estate are that, hey, now that money is going to purchase policies on future generations. And I mean, like the Rockefellers, right? What would the Rockefellers do? If you want to read that book, great book, get your mind wrapped around how you can do this and create this perpetual system for generations to come, create a family estate, a family trust. Death benefit goes into the trust, buys more policies on everybody else. Every time somebody dies, the trust gets replenished with more death benefit that buys more policies and also becomes the bank for the family.
That's
so
right.
You go to the trust to make to borrow money.
That's right. Yeah, David Stearns told the story of when Nelson graduated a few years ago. Nelson was asking him, "Do you have any policy loans outstanding?" And he was like, "Yes, we do." And he was like, "Good.
Good. Prepare for a windfall."
Yep, prepare for a windfall. I mean, it's just phenomenal. The tale of the two dads, or whatever it was. But just IBC in action from the founder.
Yeah. I mean, money can be used to destroy a family, and it has probably way more than it's been used to bring a family together. But you could really bring a family together through a system like this.
When Tammy's grandmother died, these people were beating us up over a doll because they thought it was worth a few $100 or something, maybe, or maybe even a few thousand. It wasn't. It wasn't worth anything. And we were like, here's the doll. But it was like the dumbest thing. There was no money. Like it was so stupid.
Yeah.
Like,
so avoid it.
Yes.
Okay, next one. Precludes any need for Social Security. Interesting. So if you've got this system, which really becomes a way to multiply your retirement income in retirement in those passive income years. If this thing's been being paid into for 50, 60 years, my goodness, in retirement, you put your $5,000 into that premium and it's creating, this isn't even unrealistic, maybe 100,000 in cash value.
Yeah, sure.
That year.
Right.
Like that's a pretty cool thing to have in retirement, huh? I don't think your kids are going to be too upset about that.
No. So what Dave just said was, 40, 50 years in, this His son is still paying his $5,000 premium. He's in his 70s now, and the cash value goes up by $100,000. So he gives the life insurance company $5,000 in premium that year, and the cash value in the policy increases by $100,000.
Yep. Pretty
Very
outrageous.
realistic example of why they get better with age.
Yeah. Yep.
Anyway,
100%.
What else we got? So passive income is assured. That kind of ties in. Right, we've talked about using, Nelson talks about using either partial surrenders or dividends for passive income in retirement, although then he puts an addendum in there that says, I would never do it this way. I would use loans because they're not taxed. And there's various ways you can take income from the policy, and everyone's situation is going to be slightly different on how they decide to do that, but that's what these are designed. The longer these are seasoned, the more passive income opportunity there will be. And of course, in this example of buying policies on babies and then expanding their system as they become adults and whatever, there's going to be a tremendous amount of value, efficient value that they can draw from. So absolutely.
Yeah.
Great
I mean, my
source of
6-year-old, she's 8 now, almost 9. We got her policy when she was 6. She'll have over $1 million of cash value at age 62.
right.
So, I mean, it could be more, it could be less. That's illustrated. Includes dividends.
Sure.
But assuming things go as they've been going for 100 plus years, I think that's pretty accurate.
Yep.
What
You
can
talked
expect.
about this. Estate planning is greatly simplified. I almost feel like what I was thinking about with people we've heard about, or with our own families or friends, is that there wasn't any money or enough money to go around. Really, it was just kind of there was either nothing or just a little bit. Mm-hmm. But maybe, and I don't know if this is true, I'm just kind of thinking about this, is maybe if there's so much, it won't matter because they've been taught over their lifetime to respect it and to value capital and how to treat it with respect, so that maybe it won't matter. Right.
Yeah, but it's not just estate planning that's simplified. Like people use college, they say for college in a 529 plan, which is, we will both agree, that is probably, perhaps, I can't say the worst, I won't be that dogmatic, but one of the absolute worst places you could put money, period.
I was that dogmatic a couple of episodes ago.
Yeah, because maybe I don't know all the places you can put money, and maybe there's dumber places to put money, but a 529 is one of the dumbest places you could possibly put money. And I'll go on the record saying that. But so we talk estate planning simplified. What about everything else? Like, how about college?
Yes.
That's greatly simplified because you have access to that cash value to use for whatever, whenever you want. It doesn't count against, FAFSA doesn't recognize it, so it doesn't count against you if you need some help. I mean,
What about this? You only have to prove that the 529 money was used for, let's say, an education expense like college tuition or books.
so you have to keep very good records.
Keep the good record. So that's a must. You must do that. Keep the receipts. Show where the money went.
Yep.
What you could do, though, so not all is lost. If you've got a ton of money in 529s, and again, I've met several people lately that have 6 figures in these things, is you could cycle that money through premium first and use other monies you have, right? So you've expensed the 5. This might be an accounting issue. I don't want to get into that really too deep, but I think you could do that. Like, you eventually show that, yes, these dollars were used to buy this, right? We took $20,000 from the 529, spent $20,000 off on tuition or something, right? And you have that receipt. But in actuality, you used another 20 grand to do that, and 20 grand went into a policy.
Okay.
As premium. Does that make sense?
Yeah.
I don't see why you couldn't do that.
Yeah, I don't know either. But the complications surrounding it based on where, because how many different kind of plans are there depending on what state you live in? There's restrictions, there's limitations, there's a complex record keeping. And then, but then they throw this benefit to you. It's kind of like, hey, when the government creates a problem and then gives you a solution. Aren't you a little suspicious? They're like, oh, well, now you can do a Roth conversion of your 529. But of course, there's very specific criteria you have to meet to do that. There's only so much you can convert to a Roth, all these things. So, if you're thinking that, if that's your reasoning for doing it, that's a terrible reason. I'm sorry. It just is. But they try to butter these things up to make them just a little more appealing, a little more appetizing to get you hooked on it. Like, hey, look at this over
Yes.
here. It's really, really, really good. You should do it. Okay. Well, how about think of all the things you can't do with that money?
Again, the intent is great, and the discipline has been great, but it's the wrong vehicle to do these things.
Yeah.
And again, it's all by design. It's a government Wall Street money grab. That's all they are. I'm sorry. That's all they are.
Yeah. All right. How about this one? Wealth mentality is transferred to succeeding generations over a long period of time to produce consistent understanding. They are learning a process, not buying a product. And we've hit on that.
Yes, yeah.
Now you have to be intentional because of what your kids are going to inherit someday, guaranteed. As long as your children outlive you, they're guaranteed to receive this. So you have to educate them.
Yes, we've talked about it on the way to school. I drive the kids to school generally in the morning. Although Tammy's going to start doing that. But we talk about it. We talk about these assets that they're going to have to maintain and be responsible for and understand how to use and why we do it. And it's going to take study. And of course, my daughter doesn't really read on her own. God bless her. I'm like, you need to read. The smartest people I know are avid readers. I say that all the time. Anthony's kind of sporadic in his reading, but does like to read. So, yeah, I like the way you put that. You're gonna have to be intentional about, because it's great. It's a great responsibility that they're going to, and of course, hopefully, they're going to be in their 60s when this happens, right, Dave? Like, when we graduate, hopefully, when we're in our 90s, I'm assuming,
Yeah.
after a rapid, great quality of life and then rapid decline, like
Yep.
one day, like, oh, died in his sleep. All right, great.
Yep. It's coming.
It's coming.
I'll give you one final phone call. Yeah. So you're right. And just having these conversations, like talking about money is a good thing. Yesterday,
Yes.
case in point, my son got home from school, my youngest, Blake, and he just came into my office, sat down in the chair across from my desk, and just started asking me questions, random money related financial questions. And we just had like a 10-minute discussion on money, and he was genuinely interested. And he just started with, how's business going? And it led to him asking more and more questions. So it's a fine balance between me pushing stuff on them and then waiting for them to receive it. It's
Right.
like Nelson says, it's caught, not taught. Although it should be taught, and maybe some will catch it, some won't. But yeah, it's exciting when they come to me and start talking to me about money instead of the other way around.
Yep. No, that's awesome. That's a major step, actually. I think
Yep.
that's good. Good on them.
Yep. All right, the final bullet here promotes the understanding of what stewardship is all about.
Right. Kind of just touched upon it, right? Like, yeah. You
Right.
need to, I told my kids, your mom and I have established this thing or these things or whatever, this mindset, and this is how we do it. Your job is to double it. Just a simple thing they could understand. Like,
Well, it kind of moves the conversation from if I ever have a lot of money to when I have a lot of money.
right.
So you can train your kids to think about that, hey, this is coming to me someday. It's not hypothetical. It's not, because most people grew up, oh, I'll never be rich. I'll never have a lot of money. I'll never be a millionaire. Well, I can tell my kids when you become a multimillionaire overnight, you need to prepare for that. And hopefully you're already a millionaire in your own right before you ever receive this cash, because then you'll
Yeah.
respect that money a whole lot more.
That's right. They better be, right? They better be, because that's what it's going to take to live a decent life through inflation over the next 30, 40 years. My goodness.
Sure.
Right.
Yeah.
So it's all relative. In today's dollars, though, yes, like for sure. Like 8 figures, doing pretty good.
Yeah. So, Nelson ends this section of the book by saying money won't buy happiness, but poor stewardship of money will steal happiness.
I love it.
That's a great one, man.
Yeah.
I'm also a fan of the quote, money can't buy happiness, but it can buy a boat. You ever seen somebody unhappy on a boat?
No. No.
Yeah.
We love our boat, and yeah, it's great. It's paid for and doesn't really cost me much.
Really?
No, one oil change a year. That's it.
Yeah.
It's
Well, it's new enough that it's not breaking all the
$250.
time on you, right?
Yeah, it's got 250 hours, I guess now, which is 25 hours a year. So it's not a
Yeah.
lot. Easy hours too. I don't wind that thing out, so
Yeah.
it's been treated like a lady.
Good, good. Well, let's talk. We talked all Nelson's points, which are great reasons for having this, putting this in place for your children
Yep.
and follow on generations. But let's talk a little bit about the more technical side of like structuring these policies.
Okay.
How is
Yeah.
a juvenile policy different from an adult policy? What can you and can you not do with these?
So most people think that their juvenile policy is going to be more efficient. Like, should I start with the kids? I'm like, well, no, your kids have no income. Like, the idea behind insurance is to replace somebody's income
Right.
and their future income, right? Over the next 20 years, 30 years. So they're actually like less efficient. They're actually kind of like equivalent to like a juvenile smoker. It's kind of how they mathematically come out, and then they become more efficient as they enter adulthood. You can you make that change or whatever. But so since they have the long duration, long time horizon, I like to make the policies, if not 100% base, damn near close to 100% base premium.
Okay. So a lot heavier on the base. Why is that?
A lot heavier on the base. Well, it gives them the ability to pay the premium that the parents want to pay for the longest period of time,
Right.
right? And the premium is going to feel cheaper. We've said that on the podcast before. It's going to feel cheaper as time goes on. So you want to keep, the desire is, I used to think of it, oh, the premium's going to drop. That's good. But no, it's not. I want to keep adding more premium. So I want to sustain the premium. Personally, and I talked about it a few episodes ago, I just opened up a policy that was 70% to the base and 30% to the PUA
Yeah.
on me. And
On
I
your-
sell
on
it to
yourself.
myself,
Right.
everybody. Like, so it's, it doesn't matter. I can make it 90% PUA. I don't want that, right?
Yeah.
I want the premium to stay as high as it can be for as long as possible. Anyway, and when it comes to dividends that you earn in the policy, the base premium, and I showed Dave this the other day in the policy that I opened myself. Actually, this was a client's policy. The difference between the premium credited to the PUA premium and the base premium was over an 8x difference.
On the dividend credited
The dividend
towards
Yeah,
that.
the base premium dividend was 8 times bigger than the PUA. And this was a 50-50 split policy.
Yeah.
So even
Okay.
base, even PUA, the dividend on the base is 8 times larger than the
Yeah.
So, as rates are, kind of sustaining or going up or whatever, and dividend rates continue to creep up, that's a good thing. I'm going to enjoy more of that upside of the dividend. So,
Right.
more permanent death benefit, of course,
Yeah.
is another
And-
reason.
Right. That permanent death benefit, which grows every single year. So you may only start out with maybe 150, 200,000 in death benefit, maybe, but they're going to be well taken care of, or their kids are going to be well taken care of. Once they're in their 40s, 50s, they're going to have plenty of death benefit. Now they're not going to want to stop there. They're going to want more as they get older.
Right.
But this one policy is going to create a lot for them. And I like the heavier base because, yeah, you may have less cash value in the early years. But if you go heavy on the PUA with these juvenile policies, what I've seen is a lot earlier in life, it cuts that out of their premium so they can only pay the base.
Right.
And then, so, they get into their prime earning years or whatever, and they can only pay the base. They miss out on being able to put more premium into that. So a lot of different reasons for that. But
Yep.
yeah, that's the way we like to structure juvenile policies.
Yep.
Now there's different riders as well. I think one of my favorite riders for these juvenile policies is called the option to purchase additional insurance, OPAI for short. And what this does is it's kind of like having a convertible term policy as an adult, where regardless of what happens to you health wise or in any way, you never have to go through underwriting again, and you're guaranteed, these children are guaranteed when they hit a certain age, it's like age 22, and then for the next, every 2 years, for the next 20 years, they have the contractual right to create a brand new whole life policy for whatever amount they put on that policy, maybe 150,000, without any underwriting whatsoever. Or anytime they get married or have a kid, they can get another policy. So it ensures it guarantees their insurability. I mean, we've had clients whose kids came down with type 1 diabetes right after their policy was enforced, like within a year.
Yep.
But they have these riders, so now they're guaranteed to be able to get insurance in the future, even with diabetes. Doesn't matter.
Yeah, I wouldn't be able to stress that enough. If you are a type 1 diabetic or insulin dependent diabetic and you have a child, please reach out to us so we can get a policy on that child now.
Yeah. Do it now. In fact, I'm working with one client who's coming back for policies on his children, and he wants to do more than the OPAI will allow. So we're working the way around that because that's per policy. So maybe it's a matter of having a couple policies on each kid and max out that OPAI on each of them so they have more insurability as they get older. So, we're game planning some stuff there because he sees the value in that down the road.
That's right. Yeah. Yep. Again, the future's unknown. We've had a handful of people that come through our process that get denied, or we have to kick them to a different company maybe, or things happen, or they're just uninsurable because of something that happened in their health or their mental health even. And these people that are desiring to do this, but they can't, so they have to practice IBC through somebody else, which is not the end of the world. But if you're the primary breadwinner or one of the breadwinners, it is a big deal. So
right. Yeah.
Can't do it soon enough.
Yep. So, all right. I think we hit most of what we want. I would leave people with this thought: is how would your life be different if your parents had done this for you when you were, say, 5, 6 years old, 10 years old? What kind of, if you had access to hundreds of thousands of dollars of capital, of cash value, how would that change your life right now? Or go back even a further generation. What if your grandparents had done this for your parents? How would that have changed their lives and even more radically changed yours? So you could be that person who just starts this for your family. So do it.
You should be this person.
You should be. It's your duty.
Yeah.
To start this. Somebody has to in the lineage. If nobody else has, it's your duty. That's the way I see it. And
the other, unseen advantage is, gosh, you get to work with Dave and Paul. I mean, what could be better?
I know, right? I don't know. We like working together so much. We're going down to Florida to hang out together.
Yeah, that's like tradition now. Not Florida, but
I wish. I'm looking forward to getting out of this. We're getting snow tonight, and it's going to be like 80 degrees tomorrow in Florida when we show up. So,
right,
I'm ready for that.
Yeah, for sure.
Yeah. All right, everybody. Well, I hope you enjoyed. If you got any questions about kid policies, reach out to us, schedule some time, and we'll help you along. So, all right.
Want to plug the webinar one more time?
Yeah, well, so this episode, I don't think we have one on the calendar yet, but check the show notes.
Oh, we'll have one. Yeah, this one would be for April. I guess.
So check the show notes for the April webinar, and make sure you sign up for that. Register there. It should be the first link in the show notes. So, all right. Until then, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.